Hi everyone, welcome to Forex Trading Empire. In this video, I'll be doing a trade review on a CRT Gold trade we took on gold. You can see we took a buy from this order block, anticipating price to run out the CRT high, and price traded to the CRT high. Before I start, make sure to like and subscribe to the YouTube channel. Now, the CRT we used in this gold trade was identified from the 4-hour time frame. When it comes to CRT, you can use any higher time frame candle to identify a CRT and take advantage of the CRT from lower time frame. It's just understanding that every candle is a power of 3. You are anticipating a power of 3 in every candle. So if you can identify a CRT from the 4-hour, the daily time frame, and the weekly time frame, you are anticipating price to do a retracement to either the CRT high or the CRT low. And during those retracements, you are anticipating an up close candle if price were to trade to a CRT high, or a down close candle if price were to trade to a CRT low. In this example, price traded took out the CRT low. This candle wasn't a CRT, but the fact that price did a retracement, traded to the candle's low, run out the candle's low, traded into this fair value gap. After a trade to this fair value gap, makes it a CRT. You can see how price took out the candle's low. After running out the candle's low, price did a retracement back to the candle's range, so making it a CRT candle. Trading back to the range, seeing that price traded from a reference point. I've talked about this in many videos. You can go to previous video to check about CRT. I talked about that the high probability CRT is when price is inside a reference point. When price trades to a reference point and is aligned with the trend, you can see clearly on the 4-hour price is trading to the upside. Seeing the price is trading to the upside and is aligning with the trend, and this retracement back to this candle's low, running out this candle's low, trading back to the range, is showing that price is respecting the fair value gap using a CRT. Now, price took out the CRT low, respected the CRT low, did not trade below the CRT low, traded back to the candle's range. The next candle we are anticipating up close candle to price run out the CRT high. That was the bias. So we were anticipating up close candle for price to trade to price run out the CRT high. Now, going into lower time frame, we are going to set a horizontal line to the opening price of the individual up close candle to price run out the CRT high. We are looking at the individual candle as a power of 3, identifying the power of 3 and showing you how we took advantage of the setup from this fair value gap for price to do a retracement back to the CRT high. Now let's move to the 5-minute time frame. On the 5-minute time frame, here's the first candle after the run of the CRT low. Price traded lower, run out the CRT low. After the run on this CRT low, here's the opening price of the first candle. On the opening price of the first candle, you're looking for price to trade to a discount liquidity because we're anticipating higher prices. And as soon as price opens from the opening price traded to a fair value gap. Now that was the first advantage we took in this setup. That was the first trade we took in the setup. From the opening price, you can see the retracement back to this fair value gap. Here's the fair value gap. The retracement back to this fair value gap was the first setup. Looking for price to trade to a buy side liquidity, a premium liquidity, which would be this equal high, close to an equal high, first high, second high, like a double top. We're looking for higher prices where price will run out the high. We are using the bias from the 4-hour. Understanding bias from a higher time perspective gives you different opportunities to take advantage of the trade. The first trade was to look for higher price where price would run to this high. Price traded to this high. That's the complete power of 3. Open price, trade to a discount fair value gap, traded higher, run out a buy side liquidity, a premium buy side liquidity. Moving to the second candle. The second candle, price open. Here's the opening price of the candle. From the opening price of the candle, price haven't traded to a major liquidity to identify a shift in market structure. Price haven't traded to a major liquidity. Looking for price to trade to a major liquidity, price traded lower, run out sell side liquidity. After the run on the sell side liquidity, since it's not a continuation, price is going for liquidity pools, going for the sell side liquidity. We're looking for price to do a shift in market structure after the run on the sell side liquidity. Price traded lower, run out the sell side liquidity, trading to a discount. After trading to a discount, price traded higher, retrace back to the other block. Here's the other block. This candle traded lower, took out the sell side liquidity before the shift in market structure. Price shift structure from a down trend to an uptrend. This is the candle that run out the sell side liquidity, which this candle is an order block. A retracement back to the other block, stop loss below, anticipating higher prices. And what will be your next draw on liquidity? For price to go for the swing high and for price to go for the CRT high. Because we know that the CRT high is our target, is our full target. So we're anticipating higher price for price to trade to the CRT high, maintaining the trade since we are at the second candle and price is still showing that price is going to the upside. That was where we took the trade, we held the trade for price to trade to the CRT high. Now moving to the third candle. Now in this third candle, here's the opening price. Price open, traded to a discount fair value gap. From the opening price, price traded to a discount fair value gap. Here's the fair value gap. After creating this swing high, I have to move this rectangle a bit. Price created a swing high, left this fair value gap, open. From the opening price, price did a retracement to the fair value gap, respected the fair value gap. This is another entry. Taking advantage of this entry, price traded higher to a premium. You can look for easy target for price to run on this swing high, but your stop loss will still be below the fair value gap, anticipating higher prices. Price traded higher, use the last candle to run out the CRT high. Now if I'm to place the position tools in all the trade we took, this was the first trade. Looking for price to trade to the high. Here's the second trade from this other block. Looking for price to trade to the CRT high. The 6-hour trade. And the last trade. Looking for price to trade to the CRT high. And this is a 5.5-hour trade. Now I went through individual trades to spot out the entry level using the power of 3, identifying every candle as an entry model through the power of 3. After the first entry, we waited for the next 4-hour candle to open. If price were to trade directly to the CRT high with this first candle, then this would have been the only trade which I had taken advantage of. But the fact that price created an up-close candle with the first candle, the second candle, price haven't traded to the CRT high, and we are still anticipating higher prices. Price traded lower, took out the sell side liquidity. After even on the sell side liquidity, there's a shift in market structure going above the opening price. If price were to retrace back to a discount, it will be the other block that run out the sell side liquidity as our entry. Price retrace back to the other block, use it as an entry model, anticipating higher price for price to go for the CRT high. The opening of the third candle open, price traded to a discount fair value gap. After retracement to the discount fair value gap, anticipated higher price for price to go for the CRT high as an entry model. Price traded to the CRT high. You can see how price traded the CRT high, on the CRT high. After the run on the CRT high, it's best for you to wait for another higher time frame setups. You can either use from the daily time frame or from the weekly time frame, but as soon as you get to your target, you slow down on your entry, because if you were accumulating these positions going for the CRT high, you must have taken partials on each of these swing highs. With taking partial is very crucial when it comes to accumulating position. If you're going from small position, like an example from this trade, going from a 0.5% the first trade, 0.25% the second trade, 0.25% the third trade, taking a total of 1%, taking partials from all the swing highs for price to run on the swing high, and your full target will be for price to trade to the CRT high. More on CRT is well discussed in the FOREX Trading Empire 2025 mentorship program. If you want to join the FOREX Trading Empire, FOREX Trading Empire 2025 mentorship program, the link is being linked in the description below. You can either chat me up directly from my Telegram profile, or you join the Discord community and go to the chat room to ask if how you can become a member of the 2025 FOREX Trading Empire mentorship program. We're going to be talking about how to align all this reference point, the fair value gap, the order block with CRT. That is our major topic for the 2025 mentorship program. So that's all for this video. See you guys in the next video.